Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing, and we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show.
All right, ladies and gentlemen, welcome back to another episode of the Tech Guys Who Invest podcast, where each week we teach you how to invest wisely and safely. On this episode, we are talking about the inescapable four-letter word that every single investor has to deal with. Whether you are just starting your investing career or you're a multi-billion-dollar corporation investing money, you always have to think about risk. And today, on this episode, Adam provides his perspective as a multifamily investor and how he assesses risk, and I do the same as a note investor. If you have a particular way of assessing risk, let us know. We'd love to hear it. We love conversing about this stuff and sharing ideas. Shoot us an email at techguyswhoinvest@gmail.com. Now, before we begin the episode, if you could please leave us a 5-star review on whatever platform you are listening to the Tech Guys Who Invest podcast on, that would be awesome. We love what we're doing, and we want to get as much exposure as we can so that we can educate as many people and help them achieve financial freedom. So without further ado, here's the episode on how we assess risk. Adam, how you doing tonight?
I'm doing pretty awesome, Kevin. How are you?
I am doing fantastic. So one thing that I wanted to talk about and share with our listeners is this idea of risk. And I've been reading a lot, as you know, and we shared on a recent episode, the books we've been reading in 2019. And every investor out there talks about risk. There is no such thing as a risk-free investment. And if you think putting your money in a savings account is an investment, then keep listening to our show, please. But with that being said, I wanted to ask you, as a note investor, have a way I assess risk, in which we'll talk about later. But from a multifamily perspective, how do you assess risk before you and your team purchase or make an offer on a property?
Okay, so I'll answer that, Kevin. But before I do, isn't risk like investing in real estate? Isn't that risky? Isn't it safer just to put your money into a 401k or mutual fund?
That's a fantastic question.
We could do an entire episode.
So. Yeah. And I still want to get the founder of the 401k on our podcast. We gotta make that happen.
Yeah, that'd be awesome. So, yeah, okay. So all kidding aside, I don't think so at all either. And I used to, I don't know that I would say I believed that, but it was kind of in my mind somewhere that the real estate thing, I didn't quite fully understand all of that. And it certainly seemed riskier than just putting my money into a stock fund.
Sure.
But now, of course, I am completely 180 on that one. And I think putting your money into a 401k or mutual fund is very, very risky compared to investing in a real estate asset. And one of the reasons I believe that is because I can control a real estate asset. So you asked about some of the things I consider when we're looking at multifamily deals. And those are things that I look at before we invest in a deal, and why I think it's safer, because I understand the components of a property that contain risk very well before we invest. And I make a determination that I'll accept the risk, if any, that it has. So some of the things we look at, really, some of the big things we look at are the numbers, the financials. I look at multifamily properties as businesses. So I'll look at how the operations are running. That's really a big thing, is how is the asset being managed currently? So that's something we need to understand really well. But once we understand it really well, then it's not really a risk anymore. We put a plan around it. We put a business plan around it. Other things are due diligence. So we need to be sure that there aren't issues with the property repair or maintenance issues, especially severe ones like structural issues, um, like the ground being contaminated with something. Perhaps there is a site nearby that has leached some sort of toxic chemical into the soil, and you test for those things. When you buy properties, you have these soil tests done, you have surveys done, you have the property inspected, and those are ways that we look for hidden risks.
Sure. Okay. So with the structural things, the soil, that I feel is a bit more intuitive because it's tangible. You can go in and see, you can look at a roof and say, okay, I estimate that we're going to need a new roof in the next 5 years, or whatever. You have an inspector come in, they can provide you with pictures and talk about things like termite or what's in the soil. That to me is intuitive when you assess the risk that way. But when you mentioned looking at it at a business, what are some markers that you see that scream, wow, this is too risky, or this is a safer investment?
Yeah, well, the interesting thing about it is I don't really think there's I couldn't see it being too risky when looking at a business operation. It's just a matter of making sure you really understand all the parts. And it's a pretty simple operation, really. I mean, you are taking money from tenants in exchange for providing them a place to live. So you're looking at the rents, the income there in terms of rents. You're also looking at expenses, and that's really where they're often mismanaged. Things will, like contracts will be stale and not renegotiated with contractors, like the people who provide the dumpsters or the people
Right.
who provide service, right? Um, Landscaping, those types of things. And also, you'll want to look at things like, are they keeping up with maintenance? That's part of the operation, is when things break, you're fixing them. So you want to be looking at that kind of thing. Um, how are they running their business? Are they using marketing, or are they just trying to advertise themselves? Those are expenses that you'll look at as well, depending on the size of the property. That can mean different things. Um, anything really that you would you would spend on the property to keep it running would be looked at and considered. And then at that point, you just have a business plan around how you're going to address that.
So that if I understand correctly, you're saying those potential ideas or those areas of risk could be business opportunities.
That's the way we see them. If we find areas where they're being mismanaged, we get pretty excited about that, because that's a big opportunity, and that would actually make the deal more attractive to us. If things are running like a well-oiled machine, then there's less opportunity for us to improve the management and therefore reduce the expenses and therefore increase the net operating income and therefore increase the value of the asset. So we would then be looking for other areas where we could add value, like the property itself. Maybe it's outdated, or
Sure.
things like that.
That makes sense.
Right. Yeah. So I think the important thing there is really just to do a very thorough due diligence when you're in that, and that's where the risk lies. Right. Not everyone does that, believe it or not, and I think that happens more on smaller properties with less professional teams. So me and my team, we really see ourselves as professionals. We're trying to play like the big boys do. Right. So we address it that way. We approach it as a business would. But if you've got somebody who owns, say, an 8-unit property, and they manage a lot of it themselves and that kind of thing, that's where you'll see that they're not treating it like a business, and some things are not being done professionally a lot of times.
I like that. You operating as a professional, so you have this particular lens or perspective that you approach each property at, I think is a great way of not only protecting yourself, but you kind of step into a different mindset when you think this isn't just like a side hustle. This is a business that you're trying to grow.
Right. Yeah. And having that mindset allows us to take advantage of opportunities that others don't take advantage of, because they wouldn't run it more efficiently. Therefore, they couldn't improve the value. So, Kevin, in the notes space, What types of things do you look for when you're assessing risk?
Yeah, absolutely. So the first two things that I look at, usually if I am looking at a tape or a spreadsheet of notes, or if I'm looking at a note on a and market exchange like PaperStack, I will always look at LTV and ITV. More specifically, I focus on ITV. So ITV stands for investment to value, which is going to be what I'm going to buy the note at and what the property is valued at. And LTV is loan to value. So what the loan amount is relative to the value of the property. Now, these are, in my opinion, just two quick markers that you can see and leverage to understand if it's too risky or within the range of your comfort level. So, for example, when I look at a note or number of notes, I look at ITVs 65% or less. And the reason I do that is because if my team and I buy the note and something goes awry, we know that there is at least 35% leeway on if we had to sell the property as is, we could either make money or we wouldn't lose as much, if any at all, because there's so much of a cushion there. So those are a couple of things that I look at. I also look at the worst case scenario. The worst case scenario being I end up with the property. Could I sell the property? That's why I'll avoid highly rural areas, because if I have to end up with the property, who am I going to sell it to? And I don't want to be put in a position of desperation to sell it at a loss or just sell it to anybody. I want it to be in an area where there is potential opportunity for me to sell it for a large profit. So I look at that as well. Another thing that I look at is the payment history, especially if you're looking at performing notes. How long have they been performing? If there was, let's say, 1 month that they didn't make their payment, what happened there? Trying to understand that information. If it's a non-performing note, that is, you're buying a note that the person isn't paying. So that's a problem, a risk you are taking on. You know that, but you're getting it at such a greater discount, so you have that baked in. The risk is what I like for note investing is it's protected, especially in the first position space. You're protected by that real estate. So I'm looking at those two numbers, the ITV and the LTV.
That's interesting. So because you're protected by the hard asset itself, by the real estate, it's just a matter of making sure there's enough value there that you could absorb a problem.
Yeah, that is exactly correct.
Okay.
Absorbing that problem, that cushion. One thing that I do, because note investing, what I love about it is you can invest anywhere within the U.S. from wherever. All you need is a phone and some internet. And I do like what I call the eye test. So I'll put the address into Google Maps and I'll just look around the area. Okay, what does it look like? Does this area look bad? Is this the nicest house on the block? Or all the houses? Are there boarded up windows in this neighborhood? Like, what's going on here? And that gives me an idea, because I can't fly to every location that I'm looking at, right?
Right.
So is that something that you apply, that type of eye test as well?
Yeah, we'll do that when we're first looking at the property. Same deal. We can't fly everywhere, and we want to sort of walk it with Google Maps and just see what the area is like. Absolutely. And for us, location is also something to be considered. We have to really make sure that the asset aligns with our strategy in terms of what we're buying. We wouldn't want to buy, for example, we don't look at D or low income type, low maintained assets in high crime areas.
Right.
Now, we will look at some C- type assets if they're in an area that's gentrifying or it's in the path of gentrification. But other than that, we're not interested in those lower assets. So yeah, that's something we have to look at as well. Also, what you said about rural applies to our strategy as well. We're not looking for apartments in low population areas. It really needs to be within a certain radius of a high population area, a certain driving distance of a high population area.
Right, because who would you rent to if there was nobody there?
Yeah, the problem is if the existing renters leave, who are you
Exactly.
going to rent to next? And then another thing that's that's high on our mind right now is the market cycle. So we always stress test our deals, and that's really important to do in multifamily investing. We'll stress test the deal with numbers from the worst part of the last crash or downturn or correction, whatever you want to call it. So
So you're
we'll
conservative with your underwriting because you're
exactly.
saying the lowest we have in a documented record of how much this was making was this. Is this deal still feasible based on those numbers? I like that.
Exactly. Yeah. Will it survive the worst crash that we've experienced? And, that's something that's important to do, especially right now when it's pretty clear we're at the top of a cycle. Nobody knows how long that's going to last. We want to be sure we can weather any storm.
Now, speaking of, you were talking about areas that are in the middle of gentrification or areas that are on the path to gentrification. I think you can see when an area is already exhibiting some of that gentrification. But what happens when you say, when you say on the path to gentrification, where are you finding that information?
So that's a good question. You can get that information from some websites, and also from brokers and even other investors. Um, so yeah, like you can kind of look at demographic information. You can also look at the asset
Sure.
values, how much they were selling for, how much they are selling for, how much rents are now, how much rents were a couple of years ago, and that'll kind of start to tell you the story of what's going on. Also, if it's your own backyard, then you've got a pretty good finger on the pulse of what's going on. And that's something we do is right now we're investing in areas that we know really well. So we
Yeah.
know if it's doing that.
So I like what you said there, looking at the story, and that's another thing that I do as a note investor. I try to figure out what the story is, who this person is. When you make an offer or you get the due diligence, the packet, the files that say, "Hey, this is who owns it. This is the mortgage." I find out who the borrower is and do some, I guess, Facebook stalking. Right? I want to know who this person is. I look at things like the unemployment rate in that area, just so that I have an idea, or maybe what the median income is, just to get an understanding. Does this monthly payment seem feasible for this person to continue to pay? Because let's say you bought a note that's been performing the last 2 years, but you find out this person's job is they just have a history, it's unstable. That could be a potential red flag for you, because a performing note becomes non-performing just like that. So it's something to be aware of.
Now, are you also looking at things like demographics and population shifts and things like that when you're investing in notes?
I look at that for me less. I mostly look at, if for a performing note, how long they've been in there. I try to estimate the likelihood that they would stay in there if they've been paying for a while, they've been in that home. That to me is what's important. And it's important to know if there is some type of trend happening. If there's a mass exodus out, I may avoid that because, like I said, I always want to make sure the worst case scenario, I and my investors are still going to make money.
So, Kevin, you and I have figured out what we need to be looking for our investor identity, for the assets that we focus on. Think back to when we didn't know that and we just decided what we wanted to focus on. Maybe we can help some of our listeners with where they can start to understand how to know what to look for to mitigate risk on deals they're doing.
Yeah. So I remember when I first started investing, I looked at my 401k and I read this book, I Will Teach You to Be Rich by Ramit Sethi. I think it's how it's pronounced. I may be pronouncing it incorrectly. But first of all, it's a good book. And I think it provides a more passive approach as to how you can become rich by automating, setting things aside, whatever percent you can have for your lifestyle. It's more of I will teach you to have a lifestyle while investing type of book, in my opinion. And in that, he introduced target date funds. And that was where I think it kicked it off for me. But I didn't know what I was doing. I just looked at a target date fund. And typically, the later out the date is, the riskier it is. And the way that they were determining risk is you were invested a greater percentage of your money was invested into stocks versus bonds. So if you were retiring in the next 10 years, they would do much more safer investments with your money. And if you were younger, you would invest in potentially more rewarding type of investments, but riskier. So in terms of figuring out your investor identity, I think you have to ask yourself, like you have to sit and think what risk means to you. What does that look like? For me, not being able to control my money is too risky. I want the option to be able to say, hey, this is how I want to take control of it. I don't want somebody else to do it, but that's just me.
Yeah, I think that's good. And then once you do decide what type of assets you want to begin investing in, then you can start to search out knowledge experts in those areas and start reading their content, their books, check out their websites if they have a podcast. That'll give you some information about assessing risk on the asset class that you're interested in.
I would also say go with what you enjoy or you're familiar with. There are a lot of people out there that are familiar with apartments, so they start investing in apartments, or people that prefer single family homes. I think there's an aspect there you need to ask yourself what you're familiar with, and also how much time you have to give to dedicate towards something.
Yeah, because across the asset classes, my belief is there are none that are more risky than others if you're addressing it like a professional investor. If you are doing your proper due diligence and assessing the risk on each potential opportunity, then you are reducing the risk. You're making it manageable at that point. So it's not risky because you're educating yourself on the deal before you pull the trigger on it.
Yes.
So that's the important thing, right? It's just make sure you know how to analyze the deal and make sure that you're considering everything you need to. The type of asset it is, it doesn't matter that much as long as you're doing your homework.
I agree 100%. And the most successful investors that I've read up on, they all figure out how to mitigate risk first. And then once that downside is covered, in the worst case scenario, once that's covered, they focus on the figuring out how to make it more profitable.
Excellent.
Well, Adam, this was a great conversation about risk. It wasn't a very risky talk, but
nice.
But to our listeners, thank you for tuning in to this week's episode of the Tech Guys Who Invest podcast. We want to know, how do you assess risk before you invest in something? Let us know. Let us know on LinkedIn, Facebook, Instagram. Shoot us an email as well.
Also, if you have questions or want some help with how to understand risk, analyze risk, or just some pointers on where to get started, reach out to us. As Kevin said, you can look us up on LinkedIn, Tech Guys Who Invest, or one of our other social media sites. Also, you can email us, techguyswhoinvest@gmail.com.
Thanks, everybody.
That's it for this episode of Tech Guys Who Invest. This is Adam.
And this is Kevin. Thank you so much for listening to us. Don't forget to join our Facebook page, where we're building a community of investors so that we can share ideas, tips, and other ways to help us get out of the rat race. If you found value in this podcast, it would mean the world to us if you could share it with your network. Lastly, we love feedback. It's how we get better. So if you wouldn't mind spending 30 seconds and leaving us an honest review on iTunes or Stitcher or whatever platform you're using, that would be super sweet. If you want to get on Adam or Kevin's calendar, go to tgwipodcast.com/contact. We want to help you invest safely, wisely, and ultimately get you out of the rat race. Thanks again.